Hello and welcome to youshallpass.com. This video is about the part of reading 57 that covers spot and forward interest rates. So far, we've been using only one YTM to discount all the cash flows of a bond regardless of when those cash flows occur. The discount factors may change due to a change in the discounting period, but the interest rate used to calculate those discount factors remains unchanged. However, towards the end of the curriculum reading on Introduction to Bond Valuation, you might have come across a section on arbitrage-free pricing. Essentially, arbitrage-free pricing requires that instead of using one discount rate to calculate the present value of all cash flows of a bond, each cash flow should be discounted at its own particular discount rate based on how far from present that cash flow is going to occur. This approach is actually the theoretically correct method of valuing debt securities. That is, using a different interest rate to discount each cash flow based on how far that cash flow is going to occur from now. The interest rates used for this sort of valuation are called spot rates, and they are not your ordinary YTMs. They're slightly, but quite different. This is a bond and these are its regular coupons. Now, it is possible to think of this bond not as one bond, but as a package or a series of individual zero coupon bonds. Like there's one zero coupon bond that corresponds to cash flow 1, another zero coupon bond corresponding to cash flow 2, another for cash flow 3, and so forth. Looking at this diagram, it is possible to think of them this way, isn't it? And if it's not, then take a look and keep looking until you can think of them not as coupons, but as individual zero coupon bonds. Okay, now the next thing we need to realize is that whether we consider these cash flows as part of a regular coupon bond and we discount them to present value using one discount rate, or we consider them to be a package of several individual zero coupon bonds and use different discount rates to value each such bond. In the end, it's the same cash flows that we are talking about. So regardless of whether we consider them bond coupons or we consider them individual zero coupon bonds, regardless of how many interest rates we use to value them, these cash flows have identical size, identical timing, identical risk. They are the same damn cash flows. So logic demands that they have identical prices also. And as we discussed in the video about bond valuation, identical price essentially means that the present values must be equal. So a relationship that looks something like this must hold. And as you can see, the left-hand side relates to conventional bond pricing, and there is one interest rate that's being used to calculate the present value and the discount factors. Whereas on the right-hand side, we have the arbitrage-free pricing methodology, where there are 4 different discount rates for 4 different cash flows. Okay, now before you move on, you need to be sure that you are comfortable with 2 things. The first is this whole idea of bond coupons being expressed as zero coupon bonds. And if you are not comfortable with this concept yet, you should back this video up about, say, 5 minutes or so and start watching it again. The second thing you need to be very comfortable with is the expression and manipulation of YTMs as bond equivalent yields. And if you require a recap on this, I suggest you watch the video about bond valuation. Okay, so we are now in a position to talk about what spot rates are and how they are calculated. Basically, the yields on these imaginary or theoretical zero coupon bonds are what is known as spot rates. They are worked out using the actual market yields on the real bonds, that is the prevailing YTMs for zero coupon and regular coupon paying bonds that are actually in existence and for which there is a reasonably deep liquid market. The left side of this equation contains data that is observable from the market. And once we have one side of it, then arithmetic helps us get to the other side. This process of deriving spot rates for theoretical zero coupon bonds from the YTMs of actual real regular coupon bonds is what's known as bootstrapping. They'll tell you that the longest journey begins with the first step, but take it from me, even before the first step, any journey begins with a starting point and a map. Bootstrapping is a lot like a journey. Admittedly, not a particularly fun journey, but you do get to travel the length and breadth of the yield curve. And before we start walking, we need to know where we are and a map that tells us where to go. In this case, our map will be the bond yield curve, and the starting point will be the section of the yield curve that pertains to zero coupon bonds. From these market yields for actual zero coupon bonds, we are going to calculate the yields or the spot rates for the theoretical zero coupon bonds, representing the coupons of regular coupon paying bonds. The yield curve shown here is for the US Treasuries market from early 2003. These were, pre-crisis, pre-quantitative easing times. So back then, the US Treasuries yield curve had some real shape on it. Of course, regardless of what era you live in and what the nominal values of interest rates are, as long as you have the yield curve and the market yields for a few zero coupon bonds, you can bootstrap your way across the yield curve. And we'll show you just how over the next few slides. Of the yield curve, which has yields from 1 month treasury bills to 20-year or 30-year treasury bonds, we've taken this segment stretching from 6 months to 7 years. We show the yields here along with a simplifying assumption that the coupon rates for all maturities is equal to the YTM. So the price of all the bonds shown here is also equal to par. That's a simplifying assumption, yes, but in no way does it obfuscate the explanation of how spot rates are calculated. This yield curve is our map, and the top two rows, which are the yields for zero coupon bonds with 6 months and 1 year to maturity, they will serve as our starting point. Recall from the reading or the video on bond valuation that the bond world lives, breathes, and calculates in 6 monthly intervals. The YTMs shown here are actually worked out on the basis of 6 monthly intervals, and then the bond equivalent YTMs are expressed as simply twice the 6 monthly rate. Therefore, to get a true picture of what's actually happening here, we need to decompose or break down the annual YTM into 6 monthly YTMs. The half-yearly rates for the first two rows, those for the 6 month and 1 year T-bills, are shown here. They are half the annual YTM, and since the 6 month and 1 year T-bills are zero coupon bonds, their YTMs are also refers to spot rates. Our next task is to determine the spot rate for the next available maturity, which is the 1.5 year slot. Okay, first things first, we lay out the pattern of cash flows, basically how much and when. Since it's a regular coupon bond with 1.5 years to maturity, there will be two coupons at 6 month and 1 year intervals, at time period 6 month and 1 year, and then there will be a third coupon at 1.5 year along with the full face value of the bond. These cash flows are shown here. Recall from the material on bond valuation that bonds where the coupon rate is equal to the YTM, those bonds are priced at par. Since the price here is par, it's safe to assume that the coupon rate is equal to the YTM, that is 1.61%. Also, Recall from a few minutes ago how spot rates work. Each cash flow is discounted back at its own discount rate, and that discount rate is the YTM on a zero coupon bond of equivalent maturity. Since here there are three cash flows, one's occurring at 6 months out, the other's occurring 1 year from now, and the third one's 1.5 years from now. We have three spot rates. And since we already know what the first two spot rates are from the yield curve on the previous slide, we now have to work out what the third spot rate is. We know that the 6 monthly spot rate for the 6 month and 1 year maturities is half the YTM for the 6 month and 1 year treasury bills. That is 0.625% and 0.71% respectively. So, using these, we work out the discount factors V1 and V2 for the first two cash flows. The price of a bond, of course, is simply the present value of all its future cash flows. So, that being the case, this equation should hold. The first two coupons of 0.805 each are discounted using the discount factors V1 and V2, and the final cash flow, which is a bundle of the last coupon and the face value, is discounted using V3. Substituting the values of V1 and V2 in this equation, and with some basic arithmetic, we arrive at this position, which then naturally implies this position. And although I've left out some basic algebra in between, you can easily work out the intermediate steps to confirm that the value for I3 is indeed 0.806%. Bear in mind though that what you work out could be a little different from the results shown here due to the effects of rounding. So I suggest you use a spreadsheet to try and replicate this process and to replicate these results. In any case, we arrive at I3, which is then our spot rate for the third 6 monthly period, or the 18-month spot rate. We then update our yield curve for the 18-month spot rate we just worked out. We first update the column marked rate per half year, since that is actually what we worked out, and we then double that figure to quote the spot rate on a bond equivalent yield basis. Just to recall, the bond equivalent yield is twice the 6 monthly rate used to actually work out the present values in prices, etc. So now we have spot rates for maturities from 6 months to 18 months. The next slot that we need to work out a spot rate for is the 2 year or the 24-month maturity. The process itself is quite mechanical and identical to the one we just followed. It's a 2 year bond priced at par with a bond equivalent yield to maturity of 1.8%. Since the price is par, it means that the coupon rate must be the same as the YTM, and the semi-annual coupon rate by definition is half the annual coupon rate. So we have four cash flows, and we know the amount and the timing of each, and we have four discount rates, all but the last one of which we know. So we work out the discount factors based on the discount rates that we do know. We lay out the price equation here, the price of the bond being the present value of all future cash flows, and with a little bit of basic algebra, we end up with this value for the discount factor V4, and with some further basic algebra, we arrive at I4, which by definition is our spot rate for the fourth 6 monthly period, or the 24-month spot rate. Needless to say, I have omitted the intermediate steps, but you cannot afford to do that. Start from the price equation and work right down to the derivation of the I4. Don't leave anything out. It's not my ass on the line, it's yours. We then update our yield curve for the 24-month spot rate that we just worked out. We first update the column marked rate per half year, since that's what we actually determined, and we then double that figure to quote the spot rate on a bond equivalent yield basis. We now have spot rates for maturities ranging from 6 to 24 months, and although we're running out of vertical space on the working slides, we'll work out one more spot rate, that for the 2.5 year or 30-month maturity. It's a 2.5 year bond priced at par with a bond equivalent YTM of 2.01%. The coupon rate must naturally be the same as the YTM since the bond is priced at par, and the semi-annual coupon rate by definition is half the annual coupon rate. 5 cash flows, 5 distinct discount rates, we know 4 of them, and we work out the discount factors based on that. The price equation for this bond looks like this, and with the same basic arithmetic or algebra or whatever, we arrive at this value for the discount factor V5, and which leads to this value for I5. I5 being by definition our spot rate for the fifth 6-monthly period or the 30-month spot rate. Once again, although I've omitted the basic mathematics in between the concept and the conclusion here, you are strongly advised not to. In the exam, you're short on time, you're stressed out, and if you start to think in there about what the right mathematical steps are, you are asking for trouble. These are easy enough marks to get once you've figured out the concept and the mechanics. And my advice is to be, proficient in the mathematical steps that lie herein, so that in the exam you don't have to think about it. You know what to do and you do it. We then enter a half-yearly spot rate of 1.0091% in the 2.5 year row, and then double that to quote the spot rate on a bond equivalent yield basis. Um, Although we've only gone up to 2.5 years here, you should replicate this process for a few more maturities so that you're clear about both the concept and its execution. It's unlikely that in the exam you will be asked to work out spot rates for more than a couple of periods out from where you stand. And it's an easy enough idea that once you get the hang of it, you can execute to perfection in the exam and in practice. Over here, we show the entire spot rate curve up until the 7-year maturity. You can check your workings against this when you've carried them out, and that is one reason for working out all the maturities and showing them here. But there's another, deeper reason. The spot rate curve can help us tell the future. And not exactly the future, but it can tell us what the market thinks is going to happen in the future. And what we're talking about really are forward rates. And those forward rates are hidden inside the spot rate curve. What if someone were to ask you what you think the 6-month interest rate is going to be, say, 3 years from now? One option would be to say, actually, I think it depends on the Japanese and the Russians and the Chinese and on oil prices and housing prices and whatnot. The other option would be to whip out this spot rate curve, look cool, and give a scientific answer. You see that at the end of 6 months, 3 years from now, you'll end up at the 3.5 year mark. If you invested $1 at the 3.5 year spot rate today, and you invested another dollar at the 3-year spot rate, then the 6-month rate you'll need to invest at once the 3-year investment matures is your 3-year forward 6-month rate. And then you calculate accordingly. Yeah, it's a mouthful, and you're right, it will look better visually. Well, at the outset, what we do know is that we are standing at time 0. Then we take a look at what the 3-year forward 6-month rate means. One thing it means is that it starts at the 3 year mark, and since it's a 6 month forward rate, it ends at the 3 years plus 6 months, that is the 3.5 year mark. What it really means is if an investor has a choice between investing $1 for 3.5 years at a known rate and investing $1 for 3 years at a known rate and then reinvesting for 6 months at an unknown rate, the unknown rate should be such that the investor is indifferent between the two options. By indifference, we obviously mean that the investor ends up making the same amount of money with both options. Using half the 3.5 year bond equivalent spot rate and compounding for the 7 half years that lie in 3.5 full years, we work out that $1 invested will grow to approximately $1.089. On the other hand, given the 3 year spot rate and carrying out a similar compounding, we work out that $1 invested at the 3 year spot rate rose to $1.069 approximately at the end of 3 years exactly. So the rate required to grow $1.069 to $1.088 in 6 months' time can be found simply by dividing the ending amount with the starting amount. Simply 1.088 divided by 1.069 and then subtracting 1. What we get, that rate, is the 6 monthly interest rate that is implied or expected to prevail 3 years from now. And that is how we decompose the spot rate curve to discover the expected or implied future interest rates that are inbuilt into its structure. Essentially, if we were to boil down the derivation of forward rates from spot rates to a process and a formula, it would go something like this. The first thing to remember is that the bond world lives, breathes, and calculates in 6 monthly intervals. 6 months is your standard time period, and if someone asks for, say, a 5 year forward 2 year rate, what they're talking about is the rate over 4 6 monthly periods starting 10 6 monthly periods from now. More generally, let's just consider the n period rate t periods forward or t periods from now. Call the tth time period your start period and the t plus nth time period your end period. From there on, it's basically simple algebra, some common sense, and a bit of practice. You work out the amount of money you would have had you invested at the spot rate corresponding to the end period. You then divide that with the amount of money you would have had you invested at the spot rate corresponding to the start period. The nth root of this ratio minus 1 is then your t periods forward n period rate. Yep. Up next, we put some numbers on those words. We'll work through an example. We'll work out the 1.5 year rate 5 years forward from the spot rates we earlier worked out. Remember, this is the actual US Treasuries yield curve from early 2003. In keeping with the methodology we laid out in the previous slide, we determined the start and end points, these being 5 years and 6.5 years respectively. We then start the accumulation exercise. For the start period, we take the 5 year spot rate expressed on a bond equivalent basis as 3.105%. We know that everything in the bond world works with 6 months as the standard period. So we halve the bond equivalent yield and compound it over the 6 monthly equivalent of 5 full years, that is 10 half years. We end up with 1.1665 as our answer. We repeat the same working for the end period of 6.5 full or 13 half years, and that compounding accumulates to 1.2584. We then divide them both, and since the rate in question extends over 1.5 full or 3 half years, we take the cube root of this ratio and subtract 1. What you get then is your 1.5 year rate 5 years forward. And needless to say, you need to work through each and every step of this working before proceeding further with this video. Here we have another worked example exactly along the same lines, but for the 2 year rate instead of the 1.5 year rate, both of them being calculated 5 years forward. I figured there's no such thing as too much practice, so if you worked through the previous example, this one shouldn't be any trouble at all. Pause this video here, rework all the calculations shown and the steps involved before moving on. We are drawing to the end of spot and forward rates, and when we do move on, we'll cover one other important link in this chain before wrapping up this video. Towards the end, we kind of head back to the beginning, the yield curve that started it all. As you can see, this yield curve lays out the then prevailing YTMs at all the maturities for which the US government conducts regular auctions. So given that there's regular buying selling activity at these maturities, there's usually a deep and liquid market at these maturity points. Therefore, the prevailing YTMs at these points can be said to provide fairly reliable insight into the expectations of the market and the demand-supply dynamics of the market. But the yield curve isn't just these maturity points, right? The yield curve is every maturity point from 0 years right up to 30 years, regardless of whether representative trades took place along each point on the yield curve or not. Usually that is the case. The trading activity is concentrated at or around the maturities at which regular auctions take place, while bonds for other maturities see relatively sparse trading activity. So our yield curve then isn't really complete. It's got all these gaps in it, which represent, thinly traded or non-traded maturities for which representative YTMs are not available. This actually is the case in practice. However, for the yield curve to serve any useful purpose, be it bond valuation or spot trades or forward rates calculation, it needs to be complete, as in even those maturities where no trades took place need to have a corresponding YTM. This YTM, for maturities where representative trades did not take place, is actually a derived or implied YTM, and it is derived from nearby maturities where representative trades did take place. This process of using traded maturities to calculate YTMs for non-traded maturities, that is called interpolation. So the yield curve that we've been using all this while, from half a year up to 7 years, actually looks like this. To fill in the blanks, we use interpolation, which is quite simple and therefore is also sometimes called simple interpolation. We start explaining the linear interpolation process here, and the first step is that for any maturity where there is a gap, first locate the previous lower maturity where there is an available YTM, and then the next higher maturity where there is an available YTM. Next, count the number of gaps that need to be filled. That is, the number of maturities which lie in between these two maturity points where YTMs are available. Count that number and add 1 to it. Then calculate the difference between the two YTMs for the higher and the lower maturities. Divide that difference by the number arrived at in step 2 above. What you then get is the incremental YTM that needs to be added on to the preceding YTM until all the gaps are filled. Yep, again, number on words time. Over here, the first gap we have is at the 1.5 year maturity point. The adjacent higher and lower maturities which have corresponding YTMs are the 1 year point where the YTM is 1.42% and the 2 year point where the YTM is 1.8%. The number of gaps that need to be filled is 1 and we add 1 to it, that's 2. The difference between the two adjacent yields is 38 basis points, so the incremental YTM that needs to be added on to the preceding YTM is 19 basis points. We start with the YTM at the lower maturity, and after adding 19 basis to it, we come up with 1.61%, and 1.61% then is the YTM that we associate with the 1.5 year maturity point arrived at via interpolation. We fill up the yield curve with 1.61% for 1.5 year and then go gap hunting. The next gap we see is at 2.5 years, and the adjacent maturities at lower and higher maturity points are the 2 year maturity point, which has 1.8% YTM, and the 3 year maturity point, which has a 2.22% YTM. Again, there's one gap that needs to be filled, and we add 1 to it and we get 2. The difference between the two adjacent yields is 42 basis points, so our increment is 21 basis points. We start off with the lower maturity, 1.8% plus 21 basis points, which gives us 2.01%, which then becomes our interpolated YTM for the 2.5 year maturity point. Again, we update the yield curve with our recently worked out YTM for the 2.5 year maturity. And we then go gap hunting. The next gap we see is at the 3.5 year point. Adjacent YTMs being at the 3 year point, 2.22%, and at the 5 year point, 3.05%. There are 3 gaps to be filled, so we add 1 to it and come up with 4. And the difference between these two adjacent yields is 83 basis points, so our increment works out to 83 divided by 4, that's 20.75 basis points. We start with the YTM at the lower maturity. 2.22% plus 20.75 basis gives us 2.43%. 2.43% then becomes our interpolated YTM for the 3.5 year maturity. To that, we add another 20.75 basis to come up with 2.64%, to which we add another 20.75 basis to come up with 2.84%. And both of these become our interpolated maturities for the 4 and 4.5 year maturity points, respectively. We update the yield curve with our recently worked out YTMs, and then we come up to the next gap in the series, which is the 5.5 year maturity. Again, we look at the adjacent higher and lower maturities and the corresponding YTMs. We count the number of gaps and add 1. We work out the difference between the two adjacent yields and then the increment, which needs to be added to the lowest maturity. We start working from the lowest maturity right up to the highest maturity until the gap is filled, and there we have it, interpolation and yield curves via interpolation. This is our yield curve from half a year to 7 years. As we started, we showed it, with large gaps in between. The only maturities which had corresponding YTMs were points where we had, substantial market activity. With interpolation, we filled the gaps, and all the subsequent gaps from 7.5 to 30 years can be filled in exactly the same way as we've shown here. So much for spot and forward rates. You should now be able to confidently work through all the practice questions in the curriculum regarding this topic. For more fixed income videos, please return to the main menu, and remember to have faith, practice, and hopefully you shall pass.